Markets create wealth. They're the function of active minds applied to reality, of manufacturing, of markets, of meeting the needs of their customers. They employ the trader principle of voluntary trade for mutual profit. As mentioned earlier, they employ the information of the price mechanism. That is how markets work. That is why we rely on the efficiency of markets, the information of prices, the virtues of money, and the justice of profits when we create our capital market assumptions that go into the investment strategy decision and using forward-looking performance benchmarks to measure success. Hello, everyone. Thank you for tuning in to this week's edition of the Moneyball Method podcast. My name is Mark Shupe. I am the author of the book, The Moneyball Method, a Middle-Class Manifesto for Objective Investing. And if you tuned in last week, you remember we talked about investment returns. When do they make sense? And to conclude that talk, I mentioned true wealth management. True wealth management being focused on dollars of future wealth, focused on looking into the future using the only performance benchmark that matters, and that is your life as an investor. What I'd like to do today is integrate that with capital markets. The title of my talk is Capital Markets, How Do They Work? Now, clearly that is a big topic. Hundreds or thousands of books have been written about capital markets, economies, stocks, bonds, mutual funds, commodities, futures, options, all of that we can't possibly discuss in a short presentation. I'm going to focus on how capital markets are treated with regard to the Moneyball method. And I'm going to begin where we need to begin in all such conversations, at the beginning. To quote my book, money is a tool. Money is the electrical current of thriving civilizations, not because of some intrinsic value, but because money transmits the virtues of production and trade throughout a culture. Capital markets begin with money. And it is my thesis, my belief, my conviction that a healthy respect for money is necessary, important, healthy for us to be able to invest successfully and be able to measure success according to the only benchmark that matters, and that is your life as the investor looking forward in terms of dollars of future wealth. However, we live in a culture that has demonized money, and some of the common conceptions for the devaluation of currency are things like fiat currency. Every government in the world issues paper money. Almost all of it is backed by nothing, except for the productive virtues of the citizens that pay taxes to the government that issues the fiat currency. Another way to devalue money is through foreign exchange markets. If a presidential administration wants to devalue the currency, they can do so by selling it on foreign exchange markets for the purpose of perhaps increasing exports and domestic production and manufacturing. This is not good. A third way that money is devalued in our culture and by governments is by quantitative easing, through central banks, through the Federal Reserve. By trying to increase the money supply, they eventually devalue the currency. And fourth, just as insidious as the rest, is stimulus spending, or all government spending that is not used to defend rights, enforce contracts, defend borders, pay for courts. Stimulus spending shows total disrespect for money, where it comes from, how it's created, the wealth-building productive virtues of individual investors and producers. The second thing I want to talk about with regard to capital markets is prices. Chapter 2 of my book talks about that. Prices are information. Specifically, prices are the decentralized information of millions of market participants throughout the world in all industries who trade value for value through free exchange. Quoting my book, Confounding the Experts, prices will change for a multitude of reasons, including scientific discoveries, new technologies, severe weather events, epidemic disease, cultural shifts, the force of new regulations, social demonstrations, or the threat of war. The point is that inflation and price increases are not the same thing. Prices can increase or decrease for many reasons. They do so automatically, they do so efficiently, and they are the most reliable indicator to producers, manufacturers, traders, and consumers as to where the best values lie. Another aspect of prices is they are also degraded in our culture. How are prices degraded? One is through government intrusion with regard to housing and education, whether it be public funded schools, universities, and housing is also subsidized greatly by the federal government through public housing, through mortgage lending mandates. Medical services, one of the greatest intrusions in free market price mechanism is for medical services, hospitals, doctors, pharmaceuticals. Whenever you have third-party payers, there is going to be distortions in the price mechanism. Same thing is true with labor, minimum wage regulations, government-mandated public labor unions. All of these distort the price mechanism. Food and energy are also heavily subsidized. Perhaps farming in America is one of the most heavily subsidized industries in the country. And energy is subject to a tremendous amount of regulation with regard to pricing, taxes, exploration, drilling, and distribution. And of course, tariffs and licensing also distort the price mechanism. Tariffs are a tax. Tariffs increase the price of everything. There are no beneficiaries to this. Even the protected industries will stagnate and eventually become uncompetitive because of protective tariffs, and licensing tends to protect the embedded industries that are afraid of new competition from new sources. Third is markets. Chapter 3 of my book is The Elegance of Markets. To quote my book, free markets are grounded in the principle of objectivity, meaning ideas and actions that are consistent with the facts of reality. In other words, markets are kind of like the natural world itself. They don't really care about your health, prosperity, happiness. However, they are elegant. They do conform to reality. They do discount prices, provide information, reward efficiency, and in turn direct capital to talent. Yet markets are also denigrated in our culture today. One way they're denigrated is with something called externalities. These are effects that are not recorded in the bookkeeping and accounting systems of corporations. Typically, they're associated with environmental situations. However, there are an infinite number of things that are not recorded on the books of a business. That would be every transaction they chose not to engage in. Another one is consumerism. This tends to separate producers from consumers, yet all of us are producers and all of us are consumers. In fact, production creates consumption. Supply precedes demand. To pit consumers against producers can only benefit one group of people, and that would be the regulators and government. Behaviorism. This is a psychological school that suggests that all of our actions, our decisions, our behaviors are directed by things that we cannot control. It could be genetic, it could be social, but it is deterministic. We don't have control. We don't have free will. We don't have volition. This manifests itself in things like behavioral finance and behavioral economics. It assumes that most people are irrational, and most of the decisions that they make, they're driven by emotional whims. That leads to inefficient markets. That leads to externalities, and that leads to the need for the state to regulate everything, such as competitiveness, fair competition, antitrust laws. All of these denigrate the efficiency of markets. The fourth chapter of my book, Profits as Poetic Justice. To quote the Moneyball Method, the world's first great software pioneer had become the world's first great rock star. Such is the nature of turning a profit for a mass market audience of grateful customers. What am I talking about here? Who was the first great software pioneer that became the first great rock star? I'm talking about Ludwig van Beethoven. He grew up in feudalist Europe. His patrons were the aristocrats, the people that held power within the monarchy, but he eventually shed his dependency on the patronage of the aristocracy. Thanks to the printing press invented by Gutenberg a couple of centuries earlier, printed music was becoming inexpensive and widely available, and he was able to sell sheet music, software, if you will, in order to fund his compositions, to fund his career, to fund his success. And he became the first great rock star. He was the guest conductor for the premiere of his Ninth Symphony in Vienna, Austria, while he was nearly totally deaf. He could not hear the tremendous applause, the standing ovation, the raucous noise from the crowd of people in Vienna, none of whom were the aristocracy. None of them, those were invited. It was the people that wanted to enter the hall, that were not well connected with the monarchy, that gave him the standing ovation that he could not hear. He was told to turn around to enjoy the applause, the adulation of becoming a rock star. However, profits are demonized. And in many cases today, it's been replaced by what's known as ESG investing, environmental, social, and governance. Instead of profits measuring the vitality, the benevolence, filling needs of their customers, filling needs of their employees, filling needs of their shareholders, other metrics were introduced to measure their vitality, to measure their value to our culture, to society, such as their environmental impact. Naturally, high-tech firms score higher on ESG rankings than companies engaged in heavy manufacturing. It's a self-fulfilling prophecy. Social justice. This is also known as DEI, diversity, equity, and inclusion. This is judging people not by their ability, their talent, their competence, their desire. It's judging people by things they cannot control. Their appearance, their ethnicity, their nationality. None of us get to choose our parents or our genetics or what country we were born into. However, that is what is happening with regard to ESG investing. Governance, certainly that is an important issue. Is governance, such as membership on the board of directors, based on political poll? Or is it based on someone's talent and ability to direct a company to meet the needs of its customers, generate efficiencies with regard to manufacturing and distribution, and hire management talent? The Moneyball Method is at first based on reality, the primacy of existence. Existence exists. As I write in the book, the law of identity requires certain attributes for all that exists, and the law of causality requires them to behave accordingly. The same is true for objectively defined asset classes of marketable securities. Now we're getting somewhere here. This is radical. This is new. What I'm trying to do is apply the law of identity and causality to capital markets, specifically the major asset classes that comprise capital markets as we know them, specifically marketable securities, those that are listed on exchanges, what are known as secondary markets, the New York Stock Exchange, the NASDAQ, the other various exchanges around the world where securities are traded and provide liquidity and information to investors. And what are the capital market assumptions that define each asset class? This was a historic achievement by Harry Markowitz in 1957, his Nobel Prize-winning work that is now known as modern portfolio theory. What are the defining attributes of each asset class? Quantitatively speaking, Harry Markowitz discovered that they are the median return, the standard deviation, which is a measure of risk, and correlation. How do they react to each other over time? Median return, standard deviation, and correlation are the three defining attributes of each asset class that we use in the Moneyball method to try to anticipate the behavior of each individual asset class. This is important. This is essential. This is not predicting the future. This is anticipating the behavior based on the most reliable long-term historical data sets that define each of those asset classes. What are these historical data sets? An asset class or investment strategy is defined by its range of potential returns, not the median return, as I say in my book. The range of potential returns combines the median return with the standard deviation, which is a measure of volatility of each individual asset class. We don't want to look at stocks as a category, or government bonds or high yield bonds or gold, whatever the case may be, based on its median return, because that's likely never to happen in the future. It's going to fluctuate a little above, a little below, a lot above, a lot below. What is the range of returns around the median that we can expect in the future based on the most reliable historical data sets? Correlation is another matter. And what I use in terms of capital market assumptions for the historical data comes from the Center for Research in Securities Prices. They are affiliated with the University of Chicago. You can see on the table that I'm showing you right now that the median return for U.S. stocks going back to 1926 is 10.1%. For international stocks, in terms of U.S. dollars as the currency translation, 7.8%. For Treasury bonds, 4.8%, cash 3.6%. In the far right-hand column, you can see that the standard deviation for stocks is 19.7%. That's a statistical term that measures the volatility of the asset class. Standard deviation for international stocks is a little bit higher at 21.3%. You might argue, why would I want to own any international stocks if the median return is lower, but the risk is higher? That is a great question. There is a good reason for it. It has to do with correlation. We can see that the risk associated with Treasury bonds is about half of that for stocks, which makes sense. And the standard deviation for cash in the form of Treasury bills is even lower, which also makes sense. But you might ask, 10.1%, is that likely? Is that reliable? Is that something that I can project into the future? I would say that it is the most reliable measure of the median return of U.S. stocks, but it's not something that we project into the future because we don't make predictions. We take into account the range of expected returns and how they correlate with other asset classes in order to construct an efficient portfolio that'll give you the highest potential return for any given level of risk. Which brings us to the uncertainty of the future. One of the greatest risks that we encounter with regard to capital markets is the sequence of returns. We know that with variable price securities such as stocks, bonds, mutual funds, commodities, whatever the case may be, actual return will differ from year to year. And this chart, asset class returns, shows changing market leadership for 10 or 12 different asset classes, from real estate to high yield bonds to high quality bonds to money market funds, large U.S. stocks, international stocks, commodities. Market leadership is constantly changing. This illustrates market rotation. It's also not predictable. It illustrates quite clearly that it's really not possible to predict which sectors are going to lead in any given year and which ones are going to lag behind. However, we know using the Moneyball method that the sequence of returns, the order in which they occur, in your investing life will have a greater impact on success or failure than the investment strategy decision, greater than the asset allocation that you actually employ. To quote my book, those are financial stress tests, the goal to put the odds in your favor. In casino terms, you become the house. Because we can't predict or control the future, we can use probability analysis to increase our likelihood of success for any given investment strategy, but only if we integrate that with your particular cash flow expectations, your age and life expectancy, and your financial resources by tax category. Which brings us to the risks that we cannot control with regard to individual stocks, individual companies, or even industries. Those are known as idiosyncratic risks. These are the risks that are unique to individual companies. Valuation risk, is the price of the stock currently overvalued on a historical basis? Or financial risk, do they have a lot of debt on their balance sheet? Credit risk, are they likely to be downgraded by one of the major rating agencies? Competitive risk, are there new companies entering the marketplace that might challenge the position of and market share of the company that you own? Currency risk, how much of their income revenue is generated overseas that must be converted back into dollars? Commodity risk, what are the input costs for their manufacturing? Compliance risk, what are the regulatory challenges and political situations that are currently predominant within that industry? Which brings us to political risk. What could be the impact of the next election? Or headline risk, what could be the impact if a board member or member of the corporate executive suite has some bad publicity associated with them? Then counterparty risk, what is the likelihood of a vendor or a customer reneging on a contractual obligation? All of these are idiosyncratic risks. All of these are risks that every analyst is obsessed with, trying to anticipate them, trying to figure out what the impact will have on earnings of the company, what the impact will have on the stock price of the company. And yet no one can really predict or control any of these. These are also known as diversifiable risks. The only way to manage or mitigate those risks is through diversification. As mentioned, economic and market forecasters and strategists are consumed by all of them. They can control none of them, and they can predict some of them about half the time. Using the Moneyball method, we have an alternative, one that's more reliable, one that meets the needs of the investors, and one that is easy to use and understand. There is one risk that we can manage, that we do have control over, and that is market risk, our exposure to risk. So how do markets work? As I mentioned earlier in the podcast, markets are elegant. What does that mean? Simplicity, grace, genius, and efficiency. Those are the attributes of elegance. All we need to do is manage our exposure to market risk. That's fairly simple. Markets are graceful. They discount prices. They discount all of the various factors that might affect the price of a stock and do it quickly. They employ the genius of the entrepreneur, the genius of the producer, the scientific discoveries, the engineering and technological innovations, manufacturing efficiencies. Markets are efficient. We subscribe to the efficient market hypothesis, also Nobel Prize-winning work by Jean Fama and Ken French, also associated with the University of Chicago. Markets create wealth. They're the function of active minds applied to reality, of manufacturing, of markets, of meeting the needs of their customers. They employ the trader principle of voluntary trade for mutual profit. As mentioned earlier, they employ the information of the price mechanism. That is how markets work. That is why we rely on the efficiency of markets, the information of prices, the virtues of money, and the justice of profits when we create our capital market assumptions that go into the investment strategy decision and using forward-looking performance benchmarks to measure success. And this brings us to the crux of capital markets. How do they work? specifically the capital market assumptions that we employ in order to give you the investment strategy decision that will avoid unnecessary sacrifice to your current or future lifestyle or unnecessary market risk. I maintain there is no justifiable reason to change capital market assumptions used in the simulations if new information is already embedded in the existing data. Yet the industry does that constantly. Every market strategist at every major firm will come up with their own capital market assumptions at the beginning of the year. This is the season for doing that. This is December 2nd, 2025. And all the firms that produce capital market assumptions have made their predictions for 2026 and beyond. In all cases, the expected return is lower than the historical data sets. In turn, they must also then assume that the risks are lower, which certainly is not the case. Yet every firm, whether it be a strategist or even a firm that produces software for advisors to use when they're running random simulations for the benefit of their clients, are using assumptions that are fudged, that have been massaged for the sake of being conservative. But what that does to our clients, to investors in general, is it might force them to take unnecessary risk or to sacrifice their current lifestyle unnecessarily. So capital markets, how do they work? They work efficiently. They work elegantly. They contain the information that is necessary for us to be able to make rational decisions for not only our investment strategies, but our cash flow strategy. And I hope that helps you understand how capital markets work. Thank you for joining me today, and I'll see you next week.